Good evening, ladies and gentlemen. Welcome back to Stocks to Buy, episode 10. We're finally 10 episodes deep. And today, because my parents are heading into their retirement very shortly, we're going to be talking about dividend income, dividend stocks hitting decade high dividends, and some little outliers that no one discussed directly related to this higher interest rate environment. These companies were paying damn near 10% yield, have been for pretty much the last decade. And it kind of blows my mind at the stability in this weird macro environment. But we got to start with the news. This week has been unusual to say the least, which has been every week in the market pretty much since the pandemic here. And I want to kick off by firstly talking about the indices. For the first time in a while, we're seeing the TSX actually outpace the US markets. The Canadian markets are pumping this week, which is pretty nice to see because obviously I hold a bunch of Canadian stocks. I'm in the green. I've been adjusting my portfolio. I'm going to update you on my couple $100,000 portfolio since the real estate purchase. I'll also update you on some of the smaller cap stocks that have actually been performing pretty well. But taking a look at the sectors, and I do want to talk about the news with some of these specific companies, but my God, it's like tech stocks are finally taking a breath with a few exceptions. But in the US market, because tech drives most of the indices, a lot of pain across the board, which I think at this point, these stocks have been overbought. As mentioned, it's the lower half of the market where investors are paying attention to right now. And that seems to be where money has been moving this week. In the Canadian markets, oh man, look at the banks. We're seeing BMO up 5%. A lot of the banks have been flying here. A lot of the financials and general insurance companies, energy stocks. I mean, Enbridge was up 4%. A lot of good green going across the board. So congrats to people that have been cost averaging, taking advantage of some of these higher yields, because taking a look at the watch list on StockTwits here, man, it's pretty mixed. I mean, all the banks finished green today. Nvidia's down 4% as of this moment, just today alone. Like it's been a pretty mixed bag, but it really seems to be just one of those markets that makes sense right now. It's just the stocks that got too hot too early on are finally taking that breath. And some of these stocks that, I don't know, this could just be a short-term moderate move, but I still think these lower end stocks deserve to be a lot higher. And one of the stocks that obviously everyone watched this week was Apple. What did you guys think of the Apple event? I'm very curious to see what your opinions were, because even in our chat groups, I heard nothing but utter boredom. I think Apple, everyone got used to those Steve Jobs days and the newest innovations and the crazy advancements in the iPhone. And now iPhone isn't moving and everybody knows what they're going to do to the iPhone. It's like, has the phone reached its peak, form? Is this the final form of the phone? I mean, everyone's working on what comes next. We can see that obviously with VR. I mean, who knows what could replace an iPhone? I think in my lifetime, it'll be around for a while, but there's no innovation here anymore. Apple's becoming like the past General Electric, basically of today. And you can tell that they're really focused on basic things people can afford. I noticed they weren't really talking about VR as much, or laptops, or all the high-end products to sell for this Christmas holiday. They're really focused on things people can afford in this kind of, tighter market, higher interest rate cycle, like the watches. The watches coming in at much more affordable prices for most people. I already got an Apple Watch. I'm not upgrading my phone. I'm one of those guys that upgrades my phone maybe once like every 3 or 4 years. It's not something that I rush into by any means. So it'll be neat to see how Apple performs because of everybody expanding their margins, cutting costs, and considering how well Amazon did in the last quarter. People are still expecting tech to actually do pretty well coming into the end of the year. We got two quarters left here. I'm curious what you guys think, because I really don't know what to expect. I honestly think that the stocks themselves may have gotten overbought, but who knows? Maybe they cut some costs and we see margins and bottom line EPS continue to grow. On other news, I was blown away by MGM Resorts. I don't know why this isn't like leading headlines right now. MGM continues to tank as they fight this cyber attack that's been going on. It's like it's barely been a mainstream media story. It's like Apple kind of took the forefront. I haven't seen any major YouTubers talking about it, but these are like serious hacks. Like, this took down the biggest casino companies. This is worse than card counting. I mean, there's stories back in the day where people brought in actual bombs into casinos to like basically hold them hostage and take money. And this is like next level. I'm like, they already got paid $15 million from Caesars. Like, we're talking a retirement amount of money kind of heist here. And it's crazy because there's so much preventative like software that's been coming out. And the funny thing is the preventative software doesn't mean crap. I mean, read this. This is hilarious. It's bonkers, says Alex Can you guys see this? I want to make sure you're reading this. It's kind of wild. It's bonkers, says Alex Weintraub, if I'm saying that right, a cyber crisis management expert who has worked on hundreds of ransom cases. Companies are spending sometimes hundreds of millions of dollars on preventative care, detection care, protection care, endpoint detection response, and so on. And guess what? The simplest, unsophisticated ways are how the threat actors are getting in. Click on this link and type in your credentials. The continued success of social engineering as a tactic demonstrates that humans are often the weakest link in the chain, says Alex, advisory solutions director at Trusted SEC, an Ohio-based cybersecurity firm. If you're designing a real resilient IT infrastructure, basically calling one person and getting one password or link or whatever should not take down your whole company. In stark contrast to MGM, Caesars reported that its customer-facing operations, including our physical properties and our online and mobile gaming applications, were not disrupted. But according to the filing, Caesars determined a week ago that the hackers acquired a copy of Caesars Reward Loyalty Program database, which includes driver's license numbers and social security numbers for a significant number of members in the database. I mean, you don't even hear people saying, hey, guys, we got hacked. If you came to Caesars a lot, there's a good chance your data is everywhere. I mean, it's kind of just astounding. And you know what these hackers do? They take that money. Obviously, insurance covers most of it. The rest of they have to pay out as a write-off to the company. But what ends up happening is they take all that data and then they sell it on, the dark web. And then it ends up just getting sold for even more money. Like these hackers just pulled off this is like movie worthy. It reminds me of Mr. Robot. I'm just going to leave it there. But my God, I wish people would talk more about this because it's so damn fascinating. But getting into the portfolio side of it, I've been talking to my accountant. I have been reworking some stocks and doing some stuff that in retrospect probably wasn't the best idea. But because of this real estate purchase, I'm kind of stuck in this quasi phase of I need to put money somewhere and I can't put it in my tax advantaged account. I've been buying like dividend stocks in my corporation, and I thought that would be the conclusive place to put a lot of my capital for dividend income. But my accountant surely advised me that if I don't plan on paying myself out, which I really don't want to pay myself out of my corporation, that buying dividend stocks probably not the most prudent thing to do. So I basically ended up taking quite a decent chunk of profit just in the last couple of days off some of these bank stocks. And for the time being, I did put it in VDY, which I just want to hold that Canadian exposure for now. And I'm basically going to take VDY and sell it at the end of the year out of the corporation, just pay whatever passive income tax or whatever I'm going to have to pay on it. Or even, I'll probably end up paying myself out a bit because I already took some money out of my corporation, which I'll probably utilize to avoid that passive income tax. And I'm just going to put this into growth stocks, primarily the S&P, probably some individual tech stocks, maybe some of the Qs in the corporate side of it. And then I'm going to take the money and the cash that I've been stacking, and I'm going to pile that back into VDY and my TFSA, along with, again, some S&P, and probably just keep diversifying with a little bit of growth stocks as well. And I'm just kind of stuck in this annoying spot where it's like, not having access to these tax advantaged accounts is just driving me bonkers because I really just want to buy Canadian dividend stocks, but it seems kind of pointless to keep buying them, knowing that I'm going to be taxed at 50% unless I pay it out. So I pay it out, and then I get taxed at like a nominal income bracket rate unless I pay myself out as a dividend. But then comes more problems because my corporation does make some international money. Then my accountant just said that you're just making it more convoluted than it needs to be. So I'm trying to refine this down, and it's been a bit of a mess. I'm looking forward to the end of this year. There's only 3 months. 3 or 4 months, get through this, and I'll be back in a place where every time I get a paycheck, I know where it's going, which will make me feel a lot better because, it's frustrating for me right now, but it's a good problem to have, I guess, right? So it's not like I'm under the weather here. I did take more capital and throw it into VDY just for the short term. And honestly, if I'm only holding it for 4 months, my accountant did say that I could trade these stocks. So that way it doesn't get looked at as passive income, and it'll be looked at as regular income to my corporation. And then I'll just get taxed at my corporate tax level, which is like 10%, which probably the more opportune way to go, because I love these banks and I don't want to give up the exposure. I was going to buy more of them, and she's like, why? You're just going to pay fees and you're going to sell them, blah 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 blah. So this is kind of where I sit. I just condensed it, and that way I don't have to pay obviously these $10 commissions that I get screwed on because I'm not running my corporation through Wealth Simple. Can you run a corporation investment account through Wealth? That might be a good idea too for some Canadian companies. But nonetheless, we're going to get into some of these dividend stocks here because my parents, I'm also talking with aggressively on how we're going to build out their retirement portfolio, as they finally kind of got a lot of their retirement stuff at play when it came to their real estate dealings. I'm not going to get into it from a too personal level, but my God, it is a fascinating conversation of choice. And actually, before I go down that path, I do want to point out too that I don't usually share my speculative investments on here. I was just on a live stream with the independent investor talking about some of the smaller cap, investments we have exposure to. And I'm just kind of impressed that this week specifically, it has been more the small cap realm of things that have been driving a lot of the portfolio performance, which is kind of funny, even though I don't have like, it's less than 5% of my portfolio, but I do own like crypto. Bitcoin's been up like 5% this week. I don't even look at my crypto wallet anymore. I mean, you talk about Aduro Clean Technologies, this small cap just hit an all-time high. This is one we've been talking about the entire year. This one's been performing exceptionally well from where we started buying. I am meaning to pick up a few more shares in it. I only own like $500 to $1,000 worth. I have to double check because honestly, I don't look at it that often. I should probably put it in my portfolio overview, but I try not to push these from like what I'm buying because I just advise that if you're going to speculate, don't put more than maybe 5 or 10% of your entire portfolio into these. I've also been buying up a little bit of Parcel Pal Logistics, another company that I've been talking about on the channel. These are just these really I'm very focused with some of these more speculative investments. So I'm not like spreading it out across the board. I really only hold like 4 or 5 because I put precious metals in there as well. Precious metals are a little bit more speculative in my opinion. But putting those aside, I think now is the honest time that you can truly start building a retirement fund when it comes to dividends. And me and my parents are kind of rolling around on the floor just talking about like, oh my God, like we're talking about yields we haven't seen in decades. And I mean, VDY, and the reason that I put some money in here is because when you just take the yield of this, you're literally getting all the best Canadian dividend stocks. And you just take a look at that 4.85% dividend. Ooh, baby, look at that. Look at that. You know how crazy that is from just like an index here or an ETF that's paying a monthly fee that literally just gives you exposure to Canada's largest companies. I'm like, it's kind of mind boggling, really. Even after the management fee, which is like fairly reasonable at 0.2%, you're still bringing in over, what is that, 4.65%, which is just, it's jaw dropping to say the least, right? And this is an ETF that is, offered really decent returns and has increased the dividend over time. So it's probably one of my favorite ways to just get that general broad exposure. But when we're talking about building out a dividend retirement portfolio, my parents do want to try and get higher yields than this. I'm more in the camp of maybe buy some SCHD, we'll diversify it in the US, but they want to get to certain targets. And we're going to do most of it, obviously, through ETFs. But there's that speculative part of their portfolio that even in their retirement, I don't think they should give up on. And we're looking at speculative kind of dividend growth companies, right? Companies that probably a little under the radar, pay much higher yields. And no, I'm not talking about like option ETFs, because again, I'm more adverse to the option ETFs because they don't grow their dividends over time. And in retirement, I don't know how long my parents are going to live. So I'm like, if you're going to look at stuff, try not to focus just on yield. Let's just make sure there is some performance behind the company. The dividends increase over time. There's at least 10 years of history behind it. And there's one company my mom has never bought, but she talks about it a lot. That's got to be MCAN Mortgage Group. This company's stock recently has been extremely volatile over the last few years. I mean, it can do 30% mood swings, but the fact is the company's been around for, well over 20 years. The stock has basically gone up and to the right since inception. And this company is fixated on basically what should be one of the rockiest markets for loans right now. I mean, the banks are going down. The banks have been getting hit handing out loans. And you take a look at MCAN and it's up 9.2% this year. I think it's outperforming the TSX, to be honest, and it's tapping in a 9.34% yield right now. Not only is it paying a damn over 9% yield, it is increasing the yield. It just increased the yield on earnings, and it's been paying special dividends pretty much consistently. I mean, I think last year they paid a bunch of special dividends, and since their inception, their dividends gone from like 15 cents all the way up to like 38 cents. So over 10, 20 years, they've doubled the dividend, not as quickly as some other companies, but you have to take into consideration they pay a lot of special dividends. And just take a look at this, because the dividends are nuts. I mean, in 2021 and 2022, they paid special dividends that just skyrocketed their payouts. I'm just kind of like blown away by this, because this is like a $500 million market cap company. They're managing about $4 billion in loans, and those loans are pretty spread out, right? But as mentioned, what I find most intriguing about this is when you look at like CIBC, you look at some of the banks' delinquency ratings, their delinquency ratings aren't on their mortgages. It still blows my mind that everyone thinks real estate's going to collapse, yet we're already at these record high interest rates. We've been up here for quite some time right now, and yet we haven't seen delinquency ratings in these banks they're half as much as where they were during the pandemic. You know how crazy that is? The pandemic was a worse time for the real estate market, mortgage and loaning money specifically in mortgages, than it is right now. Now, that could change in the future, but the neat thing about MCAN is they take your money. You can give them your money to loan to people for real estate, but because they focus on higher yield real estate, riskier real estate, these people are already used to this higher interest rate environment because these loans are probably somewhere between 5 and 10%. So these people are already locked in and they're used to paying what these higher interest rates are. And this company somehow has been benefiting relentlessly from this market. And I still haven't wrapped my head around it. I'm still doing due diligence, but we can see residential mortgages make up 26%. Construction loans are about 22%, which could be questionable. Commercial loans, 2%. They do investments, got a little bit of equity investments, non-marketable securities, some marketable securities. I mean, securitized insurance, insured residential mortgages. Again, I really want to point this out. Those are the risky aspects of the portfolio, right? But the substantial security is in these insured residential mortgages, making up 41% of the entire portfolio. So this company completely relies on the Canadian real estate market not collapsing. And if there's any sign the market is still strong, this company is proving it right now. Which again, it kind of just boggles the mind a little bit. This is like one of those under the radar companies, and they just increased the dividend by 6% and over last quarter. Not last year, I believe last quarter, or let me see, in the second quarter of 2020. Let me read into this because somewhere in here they do say that I'm pretty sure they just increased this over last quarter. Let me read through this. So for the second quarter of 2023, an increase of net income was 4.1 million in the second quarter of 22. Second quarter 2023 return of average shareholder equity was 12.47%. Same period last year, blah, 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 blah. I'm trying to see in here. Let me find it because I'm pretty confident that it was this quarter they increased it. So let me just spell dividend right and see if I can find it here for you guys. Because again, I know they say it at the top, but I want to see the exact year over year. So yeah, okay. So board of directors. So the increase of nearly 6% from our second quarter 2023 dividend. So this is a company in the middle of this crazy market, unlike the banks, is increasing their dividend. Just think about that. Pure mortgage company. Unfreaking believable, folks. I can't get over it. Congrats on buying CNR and RY this week. CNR is an awesome company. RY is a great company at these prices. Right, covered calls. My parents. So look, when it comes to my parents, and I want to get my portfolio in this place, I want to get to a point where I can make a will. And when it comes to writing covered calls, I don't want my parents to have to rely on trading calls or doing anything that involves any physical work. I want to get my parents' portfolio to a point because I know they're intrigued by the GICs, bonds, but I don't like GICs, even though the interest rates are really high and you can get 5-6% yields off them. The problem is eventually they come into renewal and you're going to get paid out. And if interest rates don't stay high, you can't roll it over into another GIC that pays higher than the market. And I'd rather them be in a place where the next 10 years, they never have to touch a thing. They just pull money out of the account. There's no renewals. There's no this, there's no that. They just collect cash and they can do it for the rest of their life, knowing that that cash will increase against inflation. That is my end goal for a retirement portfolio. And I know people like GICs. I just want to do the same thing with my portfolio. I want to get it to a point where everything I own, I'm happy with for like my lifetime, and I can just set up drips. And that's what my plan is going into next year. Once I can start retopping up my accounts, I'm going to make a will, and I want to make that will so it relies on the stocks I have in my portfolio to never have to be sold in a sense. And that's why I like the corporation as well, because I can hand over the shares to whoever I want. They don't have to sell the assets, and that company can forever have sustaining value, and I can make terms on how to utilize that value. I think that's the end goal, right? Because I think people that trade, they don't, like, at the end of the day, it's just money. It's not worth much. It's the family that matters the most here. And I just want to simplify it down to the most congruent, simplest, easiest way to live your life comfortably. But putting MCAN aside, I mean, look at Enbridge here too, right? Enbridge is one of these companies where I've never seen so much negativity around it, even though they just did one of the huge purchase into natural gas producers and stuff, making them like the powerhouse. I think they're the largest powerhouse in North America for natural gas. They're the largest pipeline company globally, in North America and globally, I believe. I mean, this company is another one of these companies that is so infrastructurally important. And people are like, oh, it's going to go bankrupt. I'm like, even if it goes bankrupt, what do you think is going to happen to it? Do you know how much value this company has to society in this very moment? Go to your local city, go to your local little village or town, and just go walk beside the buildings and see if they have natural gas. If they have natural gas going into the building, go read on the meter what company's supplying it. Because when I go down the road from where I live, they're all Enbridge supplied natural gas. They just upgraded massive natural gas pipelines to feed into the city. so all these different buildings could get access to. I'm like, I don't think people appreciate the infrastructure and the control Enbridge has over our like living in society here in general. It's a very intriguing play from a dividend standpoint, pumping out 7.5% right now. And I mean, what's the historical? I think that's like a record for them. Again, I'm not saying these dividends are sustainable forever. For now, I think they are, but if they decide to cut, even if they cut them by 20 or 30%, your yield is still absolutely astounding, right? I mean, let's just take a look at the average dividend here over time. I love macro trends. They kind of just expand this a little bit for us. So yeah, I mean, the yield right now at 7.5%. The only other time it was higher was during the pandemic, and these yields for Enbridge, we literally haven't seen pretty much ever. And this is like what, the fourth largest company in Canada or something. I think actually Canadian Natural Resources just surpassed, I think it's the third largest company now. I could be wrong. I'll have to double check. But then again, you look at infrastructure companies, right? Like TELUS. These are the kind of companies that I think will turn around when interest rates start to get cut. I've been talking about this relentlessly, but it is a matter of my opinion, my speculative opinion, that these world-renowned, these giants, these largest companies, when it comes to basic things we need, like telecom, when they start cutting interest rates, these companies have refined and dined. They've cut employees. They've trimmed the fat. They're paying out $500 million a quarter in interest rates right now to their debt. That's going to come to an end. And as soon as it does, they are going to explode in value. I'm telling you, just I don't know when it's going to happen, but eventually the bottom line is going to expand dramatically. It's just a matter of time. It's like a ticking time bomb. It's like a spring winding back. It's the pendulum of the market. And we're just in this pendulum swing right now of what's the cause and effect of interest rates and money printing from the pandemic. It's very intriguing stuff. Like I said, I'm not at the age right now where I'm implied to want to play this. I know Jeremy, financial education, he's like all about playing this, but that's the guy where you play it wrong once, and like he did, and you lose $2 or $3 million and you wipe out 50% of your portfolio value. And yeah, you might see tech stocks that he bought go up 50, 100%. And he's like, oh, look at all the money I made. But really, he's still down like 30 or 40% on his entire portfolio, right? Like that guy is years away from seeing any all-time high gains. Meanwhile, my portfolio can easily see all-time highs just from buying the indices and not getting the volatility out of the market. That's why I think at scale, it's easy to get exposure through VDY. I mean, you're getting huge yields. You're getting all these companies combined. And that, like I said, I bought all the banks, which was kind of just in my TFSA or my corporation, which didn't make a whole lot of logical sense now that I'm thinking about it. But like that, I was so excited because I'm like, my God, guys, like, can you not see what's happening here? These companies, it's just, it's not rocket science, right? It always boggles me how people just don't understand quality over quantity. It's just, you don't need to buy a lot of stocks. You make a list of companies, and when they drop, it's just, how hard is it for people to just buy them? I've done this over my entire investing career, and I've outperformed on a percentage basis all of these people, and I've mitigated my risk. If I didn't mitigate my risk, I'd be worth a lot more money today. But because I mitigated, I didn't lose as much money as everybody else did either, right? I mean, look at these quality companies. Like if I had to build a portfolio from scratch today without owning an index fund, I'm looking at companies like Hershey. I talked about this last week. I mean, look at Nestle. I was just at the store. We're talking about Halloween candy. Halloween candy's coming back. I'm like, Nestle, Hershey, these companies, man, they outperform tech stocks. They are outperforming tech stocks right now. And look at the 5-year return on these things. Like, I mean, Hershey's probably was a little bit more impressive than Nestle. I mean, this thing doubled your money in the last 5 years. This is a freaking candy company. A candy company is doubling your money in 5, and no one gives a crap. No one, they're boring. I mean, look at Waste Connections. This is another one that I love. I'm like, it's just infrastructure-based companies. It's like Warren Buffett kind of investing. When these companies drop, you just buy them because you need them. Enbridge drops. It's probably not the hardest thing. The banks drop. Not the hardest thing to consider that they're probably a buying opportunity. Waste Connections in the last 5 years has doubled your money. You're literally the guy that takes your garbage. You ever throw your garbage out and think, that's a good investment? No, because you're too caught up in the bubbles of AI. It's like, everyone gets caught up in crypto, then they get destroyed and wonder why. The Jeremys of the world get destroyed, and all their followers end up bleeding off to get new followers. The guys that get wrecked never come back to the market because they never understood building a fundamental base of a portfolio. And I don't know why people don't preach that enough. Like, buy companies that cannot be disrupted. They have moats. I mean, if I was going to speculate right now, and I'm going to speculate on some tech companies as I am on small caps. I'm looking at more or less companies that have the most disruptive possible future and the largest market cap capabilities. And it's no surprise that companies are like that are Tesla. Tesla is the new Apple. I mean, Apple events are so boring right now that the Tesla events are what Apple was when Steve Jobs was introducing the iPhone. And I'm just blown away how people are like, oh, it's too expensive. It's this, it's that. It's like, yeah, but if you're going to speculate on a future, speculate on a company that is inspiring what young people are aspired to want. I mean, I talk to kids, go to a public school and talk to kids about cars. They love Teslas. They're obsessed with Teslas, the self-driving. They know everything about it. And these, like my buddy's kid just came from the Dominican. We're talking about this stuff. This kid is like, what, 10 years old? And he's just going on about, oh, like, he's like, Lambos are cooler, but he's like, self-driving is insane. He's like, how do you not own something that doesn't drive itself? Like, it's those conversations, right? So when you're building a portfolio, man, it's fun to speculate. It's fun to have that future hype into what could happen and be possible, and like Apple kind of enthusiasm to only be disappointed at the Apple events. But you need to just step back from that and understand that your future will not rely on that. There's so much things that go wrong. I mean, Tesla, all of a sudden, self-driving never happens. What does that do for the valuation of the company? Because robotics doesn't make any money. I mean, there's so much risk in that, right? Whereas Waste Connections, you could have owned that and you'd have been like, oh, it's not Tesla. No one cares. No one talks about it. Look at your return over the last 10 years, 1,000% on a garbage company, a waste disposal company. Oh my, how much is Tesla up in the last 10 years? I know it's a lot, but is it like, let's just take a look in the comparables. I mean, like, we're not talking about innovation by any metric here, but since what, 20, yes, the same time period. Okay, so obviously Tesla's been a much better performer. I mean, Tesla since what, 2011 is up 20,000%. Okay, so not the best comparison, I'm going to say, but honestly, these are like unicorns. They're rarities to catch, right? I'm happy with 1,000% gain any day of the week. I would rather give up the huge risk of betting it all on Tesla to own like a dozen companies like Waste Connections and Hershey's. I'd sleep way easier at night, like way easier, not feeling like, because you got to remember, Waste Connections here didn't drop 70% like Tesla did. I mean, this thing dropped what? In these little market bumps where everybody gets scared, it drops 10%. Meanwhile, Tesla drops what? Like, it hasn't even recovered to all-time highs, and it's down like 72% from peak to trough, right? I'm just, like I said, I'm always blown away by how people look at the market, but I got to always remind myself that I don't trust myself that much when I should trust myself more, but I don't realize how dumb most people are. And I'm not trying to put myself on a pedestal, but I've been doing this for 8 years and it's like my full-time job. So I got to give some people a little bit of, understanding that they're new to this. And I imagine most of you are a little bit more seasoned watching this. And I hope you're like understanding that when, we talk about speculative companies like Aduro Clean Technologies, that, yeah, some of these sponsor my channel. Yeah, some of them I actually do like, and I'm pleased they sponsor my channel. But again, like, if you understand investing, like, you don't have to just buy index funds, folks. Like, you got to scratch that itch. I watched like Strongman was collapsing. I don't know if you guys watch some of these YouTube haters that just beat up Jeremy, and I beat up Jeremy and meet Kevin, but that is a real part of the market that I think, I wouldn't be where I am without it. I just wouldn't be. I'm not like a VT until I die kind of a guy. I'll never be an all index guy. I love dividends. I love growth. I love every aspect of the market, and I'll take advantage of it. And now it's even more fascinating because, like, when I was younger, I never got to have these discussions of retirement. I couldn't even imagine, buying real estate back then, let alone now. You're blessed to be in the position we're in because of the market, right? And it just comes from the point of doing it, just getting up, starting the day, man, and just saving that money and investing it. It's crazy. What happens in 8 years? 8 years ago, I was broke. I had no money. Now I'm in the next year or two, it's likely me and my fiance will have $1 million net worths. I couldn't like, when I started this, I had no idea how I would get there. I just know doing it would get me there. And it's just crazy how that evolves way quicker. Flash of an eye, you wake up. I'm talking to these older people that are retiring, and they all say that same thing. They're like, you just wake up and in a blink you're there. And it's crazy, right? And sometimes it's quicker. Like I mentioned a couple of weeks ago, man, my buddy that had that aneurysm, he was in a coma for a week. I didn't want to bring it up in the last stream because I didn't want to like damper the mood as I always do. But like my really good friend from high school, man, he was fully knocked out in a medically induced coma after having multiple seizures from that aneurysm. And the dude only got woken up like a couple days ago. And my buddy's dad, because I've been seeing their family. I've been stopping in a couple times a week right now. Was telling me that like he didn't even know he was out for a week. He got up and just wanted to go home. Like mentally, he's still there, thank God. But he's like, okay, let's go home. I don't want to be here. The guy didn't even know he was gone for a week. Like that could happen to any of us. Aneurysms aren't anything implied. It just happens. It's just some genetic deform that you're born with, right? The way your blood flows in your brain. It's crazy. The kid's 31. They investing to him. I mean, that could just be me right now, right? So perspective matters, right? But I'm just going to leave it there, folks. This was a quick stream this evening, 30 minutes, but I feel like I ranted and raved enough. I don't know why I'm so lit. Probably from Ryan's stream. But nonetheless, folks, I hope you enjoy your weekend. Stay cool, stay awesome. And as always, I look forward to catching you in the next one. Peace.